With the advent of computerization and technology entering the world of making balance sheets, one of the fallouts is today's accountant, the new breed of accountants, don't know how to prepare a balance sheet end to end. They know up to the stage of feeding in the information to the software, and thereafter the software takes over. Some time back, I showed you how to prepare a balance sheet without any knowledge of accounting. Today, let me take you back. Let's see how an accountant would prepare the same balance sheet. So, I'm going to take the same example. Let's say Carl had started a furniture company called Carl Furnitures. The transactions we considered were Carl introduced capital of 400,000 into the business. Then Carl Furnitures, for the remaining requirement, took a loan of 600,000. Then they used 700,000 to buy land, building, machinery in order to make that furniture. Then they purchased raw materials of 200,000 against cash payment. They also purchased 250,000 worth of raw materials on credit, let's say from a vendor called Rita. Then they spent 50,000 on manufacturing expenses. Then when the product was ready, they sold their goods for about 300,000 against cash, and they sold another 450,000 to a customer called Neil, who said, I'll pay you a month, 2 months later. The banker said, I want 10% interest on the loan. And then they paid Rita 225,000 and Neil paid them 400,000. Imagine these are the transactions that have taken place. Now let's see how this profit loss and balance sheet would have been prepared by an accountant using traditional accounting methodology. Folks, accounting is a 4-step process. Step number 1 is the passing of journal entry. Step number 2, you need to post those journal entries into a ledger. Step number 3 is you prepare a trial balance. And step number 4, you now make a profit loss and balance sheet. Let me take you through all these 4 steps. If you remember, I mentioned about debit credit also sometime back in one of the videos, because we follow a system of accounting called double entry system of bookkeeping. And that system says every transaction that takes place has to be recorded twice, because each transaction will have an impact on 2 account heads simultaneously. So guys, the first thing is when a transaction takes place and you have to record it, you need to visualize the 2 account heads. And then you have to decide which account head is to be debited and which one to be credited. For this, there are some rules. And when you reach this conclusion and you write so and so account debit, so and so account credit, this statement is called a journal entry. So step number 1, we need to pass journal entries for each of the transactions. Now step number 1, we will break into 3 sub-steps. Sub-step number 1, identify the 2 account heads. So when Carl introduced capital, which are the 2 account heads? Number 1, Carl's capital account. And number 2, assuming this money has come in the form of cash, cash account. When you took a loan, account head number 1, loan account head number 2, again cash. When you bought land building machinery, land building machine account, cash has been spent, so cash account. When you purchase raw materials against cash payment, it is raw material purchases, account number 1, and cash, account number 2. When you bought raw materials from Rita, there is a raw material purchases account, but there is no cash because you haven't paid Rita. So the second account head will now be Rita's account. When you paid manufacturing expenses and cash. When you sold goods against cash payment, Sales and cash. When you sold goods to Neil on credit, there is a sales account and there will be Neil's account. When you pay interest to the bank, interest on loan is one account head, cash is the other account head. And then when you pay Rita, there will be Rita and cash. And when Neil pays you, it is cash and Neil. So step number 1A, identify the two account heads. Now we know when Carl introduced capital, the two account heads are capital account and cash account, but we still don't know whether to debit capital and credit cash or to debit cash and credit capital. For this, again, you'll have to classify all account heads into three types. All account heads will either be classified as real accounts, or as nominal accounts, or as personal accounts. And for each of these three, there are rules which one to debit and which one to credit. What's a real account, guys? A real account is one where something is really there, something physical. So, furniture account is real, raw materials are real. A nominal account is one which you can't see, you can't touch, you can't feel, it's just a description. When you pay salary, what you can see is the money portion, but you can't see salary. Salary is a description, somebody has worked and has been remunerated. You can't see traveling, you can't see conveyance. And a personal account is when there's a personality involved. Carl is a personal account. A bank is a personal account. Carl Furnitures is a personal account. So guys, tell me, Carl's Capital, what kind of account is it? Real, nominal or personal? It's a personal account. And cash, real. Transaction number 2, loan. Whose loan? Bank's loan. Bank is personal. Cash, real. When you bought land building machine, the two account heads are land building machine and cash, both are real. When you purchase raw material and cash, again, both are real. When raw material was purchased from Rita, the two account heads are raw material and Rita. Raw material is real, Rita is personal. Manufacturing expenses, let's imagine manufacturing expenses right now, we are talking about wages. Wages is nominal, cash is real. Sales, again, let's assume you sold goods. So, in this case, it's furniture, so real. And cash is real. Sales to Neil, sales and Neil, sales real, Neil personal. Interest paid to bank, interest and cash. Interest is nominal, cash is real. When you pay Rita, the two account heads are Rita and cash. Rita is personal, cash is real. And when Neil pays you, cash and Neil, cash real, Neil personal. So folks, step number 1B, classify these accounts into three types. What are we trying to do? We know the two account heads involved. What we don't know, which one to debit, which one to credit. For that, what we have done, we have classified all accounts into three types, real, nominal, personal. Now there are rules for all these three types. For real accounts, the rule is debit what comes in, credit what goes out. For nominal accounts, the rule is debit expenses and losses, credit incomes and gains. And for personal accounts, the rule is debit the receiver, credit the giver. So guys, now we are in a position to apply the rules and pass the journal entry. So step number 1C. Let's pass the journal entries. What was the transaction? Mr. Carl introduced capital. Which were the two account heads? Capital and cash. And now we know capital is personal and cash is real. What's the rule for real accounts? Debit what comes in, credit what goes out. Guys, when Carl introduced capital, so far as Carl Furnitures is concerned, cash has come in. And the rule says debit what comes in. So we will write there's a book there used to be a book called journal. Nowadays everything is automated. The journal would have three columns, particulars, debit column, credit column. So we will write in the particulars column, cash account debit. And then in the debit column, we will write 400,000. And second account head is capital. Capital is personal. Rule says debit the receiver, credit the giver. Carl in this case is the giver. So credit the giver, you write to Carl's capital account in the credit column 400,000. Guys, this was the procedure of passing a journal entry, so and so account debit. For credit, you start with the word to. Journal entry number 1 has been passed. Let's go to the second one. Loan was taken. Two account heads are loan and cash. Again, loan is personal, cash is real. Rule for real accounts, debit what comes in. When you took a loan, cash came in, so cash account debit, 600,000. And the bank is the giver. Rule says debit the receiver, credit the giver. So two bank account, two banks loan account. When you purchase land building machine, the two account heads are land building machine and cash. Both are real. Debit what comes in, credit what goes out. Land building machine came in when you bought it and cash went out. So land building debit, cash account credit. When you bought raw materials, exactly the same. Both are real. Debit what comes in, credit what goes out. Raw material came in, so debit. Cash went out, so credit. When you purchase raw materials from Rita, two account heads, raw material and Rita. Raw material, real. Debit what comes in, so raw material account debit. So far as Rita is concerned, debit the receiver, credit the giver. She's the personal account. She's the giver in this case, so credit Rita. And therefore in English, Rita will be called the creditor of this company. And why is she called a creditor? Because while passing the journal entry, we said Rita account credit. Manufacturing expenses were paid. Two account heads are manufacturing expenses and cash. Manufacturing expenses is nominal. The rule says debit expenses, credit incomes. So manufacturing expenses will be debited. And second account head is cash. When you paid manufacturing expenses, cash went out, and the rule says credit what goes out. When you sold goods, the two account heads are sales and cash, both are real. Debit what comes in, credit what goes out. When you sold goods, cash came in, so cash account debit. Goods went out, so sales account credit. When you sold goods on credit to Neil, the two account heads are Neil and sales. Neil is personal, sales is real. The rule for personal account is debit the receiver, credit the giver. When you sold goods to Neil, Neil is the receiver, so debit Neil. And credit what goes out. Sales, goods have gone out. Real account says debit what comes in, credit what goes out. Guy, Neil account has been debited, so Neil in English would be called this company's debtor. Then you paid interest to the bank. The two account heads are interest and cash. Interest is nominal, cash is real. Rule for nominal, debit expenses. So interest account debit. Folks, when you don't know, when you read the word interest, you don't know as an outsider whether interest was paid or received. Both, it could have been interest earned or it could have been interest paid. So if you remember the rules, it will give you more of an idea. You're looking at interest. What interest is a nominal account. What was the rule? Debit expenses, credit incomes. Oh, this is interest debited, so this must be interest paid on loans. Had interest been credited, it would give you an idea this is the interest earned on deposits. So it makes accounts a little more user-friendly. And when you paid interest, cash went out, so credit what goes out. And then you paid Rita. Two account heads, Rita and cash. Rita personal, cash real. Rule for personal account, debit the receiver, credit the giver. You paid Rita, now Rita is the receiver. So Rita account debit, 2.25, and you paid cash, cash went out, credit what goes out. And when Neil pays you, the two account heads are cash and Neil. Cash is real, Neil is personal. When Neil pays you, cash came in, so debit what comes in. Cash account debit 400,000 and credit the giver. Neil is the giver. Step number 1 is over. We had to pass journal entries. We have passed journal entries for each of these items. Now we move on to step number 2. Post the journal into the ledger. Now, folks, ledger is this T-shaped statement. They are called ledger accounts. All the names that appear in the journal entries have to have an account called a ledger account. So let's create templates and keep. How many ledger accounts do we need? First journal entries, cash account debit to capital. So we'll need a cash account and a capital account. The next entry says cash account debit to loan. So cash account is already open. So let's open a loan account. And then you'll need a land building machine account and a raw material account and Rita's account and manufacturing expenses and sales and Neil and interest. Folks, in a ledger account, as usual, debits will be recorded on the left and credits on the right. Now, how do we post the journal into the ledger? I suggest read the entry loudly, corner to corner, and you will feel somebody is giving you an instruction. What does the first entry read? Cash account debit 400,000 to capital account on the credit side 400,000. It's as if somebody is telling you, please write on the debit side of cash account 400,000 and write on the credit side of capital account 400,000. Now, guys, if you look at this ledger account, does it read like a journal entry? Cash account debit 400,000, capital account on the credit side 400,000. Now, looking at it from a user-friendly point of view, making accounts readable. If you look at a cash account and you see 400,000 appearing on the debit side, what does it tell you? First of all, you need to know, is this money coming in or going out? This is where it will help if you remember the rules. Which account are you reading? Cash account. What kind of account is it? Real, nominal or personal? Real account. What were the rule for real accounts? Debit what comes in, credit what goes out. Oh, this figure is on the debit. That means this is the money received. Guys, please understand, those who do not understand accounting will know there is 400,000 written on cash, but they have no clue whether this is cash coming in or cash going out. Now you know this organization has received 400,000, but you still don't know where have they received this money from. Has it been earned? Has it been borrowed? So to make it self-explanatory, when we write cash account debit 400,000, we will write next to it the explanation of the credit side. So you will write over there to capital account. And when you credit capital account by 400,000, on the right hand side you will write by cash account. Left hand side items start with the word to, right hand side items start with the word by. Now it is complete. When you look at cash account, you know 400,000 has come in and you also know where it has come from. This is the capital contributed by the owners. I hope this is all making sense. Let's go to the second entry. Cash account debit 600,000 to loan account. On the credit side 600,000. So debit side of cash we will write to loan 6. On the credit side of loan we will write by cash 6. Third entry is land building machine debit to cash 700,000. So in land building machine account on the debit side we will write to cash 700,000, cash account on the credit side by land building machine 700,000. Next transaction is raw material account debit to cash 200,000. In raw material account debit side to cash 200,000, cash account on the credit side by raw materials 200,000. Next one is raw material account debit to Rita. So in raw materials debit side to Rita 2.5. In Rita's account on the credit side by raw materials 2.5. Next transaction is manufacturing expenses account debit to cash 50,000. So in manufacturing expenses account on the debit side to cash 0.5, in cash account on the credit side by manufacturing expenses 0.5. Next transaction is cash account debit to sales 300,000. Cash account on the debit side two sales, sales account on the credit side, buy cash. When you sold goods to Neil, the journal entry is Neil account debit to sales. So in Neil account, on the debit side, to sales 4.5. In sales account, on the credit side, by Neil 4.5. Interest account debit to cash. In interest account debit side, to cash 0.6. In cash account on the credit side, by interest 0.6. Rita account debit to cash 2.25. In Rita account on the debit side, to cash 2.25. In cash account on the credit side, by Rita 2.25. And last entry is cash account debit to Neil. In cash account debit side to Neil 400,000. In Neil's account on the credit side, by cash 400,000. Step number 2 is done. All the journal entries have been posted into the ledger accounts. Now we come to step number 3. Prepare a trial balance. What's a trial balance? What does it look like? This is what it looks like. All the account heads will have to be repeated. It will again have a particulars column, a debit column, and a credit column. Let's reproduce the account heads over here. First account is cash account, capital account, loan account, land building machine account, raw materials, Rita, manufacturing expenses, sales, Neil account, and interest account. And what is this statement? It's a trial balance. What is it? It is a trial to see that everything balances. Why should everything balance? Because for every debit, we gave a credit. For every credit, we gave a debit. Eventually, the total of the debits and the credits have to match. So guys, let's find out what kind of balance does cash account have. For that, we'll total up both the sides. Left-hand side of the cash account is 17. And the right-hand side of the cash account is 9 and 2, 11, 12.35. Debit is 17, credit is 12.35. Debit is greater than credit by 4.65. So against cash account, in the trial balance, in the debit column, we will write 4.65. Now tell me, what about capital? There's a 400,000 on the credit and nothing on the debit. So capital account has a credit balance of 400,000. Loan account, credit balance 600,000. Land building machine, debit balance 700,000. Raw materials, debit balance 4.5. Rita, credit 2.5, debit 2.25. So there is a net credit of 0.25. Manufacturing expenses has a debit balance of 0.5. Sales, credit 750,000, debit nothing. So on the credit column, we will write 7.5. Neil account, debit 4.5, credit 4. So net debit of 0.5 and interest account has a debit balance of 0.6 or 60,000. Let's find out, does the trial balance balance? Of course it balances. And now we come to the last step. Prepare a profit and loss account and a balance sheet. So folks, every item on the trial balance will now have to appear either on the profit loss account or the balance sheet. And a profit loss account has expenses and incomes, and a balance sheet has liabilities and assets. So far as the debit credit balances are concerned, expenses in a P&L are debits, incomes are credits. In a balance sheet, liabilities are credits and assets are debits. If in the trial balance there is a figure in the debit column, it has two options. It can either go to the debit side of P&L, which is expenses, or the debit side of balance sheet, which is assets. And a figure in the credit column can either appear as an income in the P&L or as a liability in the balance sheet. So first item in the trial balance is cash, debit balance. What are your choices? Expense or asset? Now, one of these options will look so ridiculous, by default you'll know is the other one. What is this 4.65 cash? Is this the cash coming in, or is it the cash going out, or is it the net balance of cash, receipts minus expenses? This is the balance of cash with you on the date on which the trial balance was made. So guys, it can't be an expense. This is money in your pocket. It has to be an asset. Next transaction is capital. Credit balance. Is it income or liability? This is not money earned by the business. It is borrowed from the owner. So liability. Loan, liability. Land building machine, asset. Raw material, debits, expenses. Rita, now the name doesn't tell you anything unless you look at the balance. It's a credit balance. So that tells you she's a creditor. So she will appear on the liability side. Neil has a debit balance of 0.5. So Neil eventually will come on the asset side. We'll come to that later. Manufacturing expenses, debit, it's an expense. Sales, credit. Income, Neil has a debit balance. So asset. Interest has a debit balance. Again, I repeat, interest by name tells you nothing. It could have been interest paid, it could have been interest earned. But since it has a debit balance, this appears to be an expense. Now, folks, we've transferred everything from the trial balance to either the P&L or the balance sheet. Now, let's find out, has this company made a profit or loss? For that, again, we will find out what are the totals of each of these two sides. The total of expenses side is 5.6. The total of income side is 7.5. Whichever is heavier, that figure we will write on both the sides. Since income is greater than expense, the company seems to have made a profit, which will appear on the expenses side. Doesn't represent an expense. It's just a balancing figure to balance the two sides, right? And the profit figure in the P&L must get transferred to the balance sheet. This profit is a credit balance. The credit side of P&L was heavier than the debit side. It's a net credit. Even though it appears on the debit side, it is a credit balance. And therefore, it gets transferred to the credit side of balance sheet, which is the liability side. And let's find out, does this balance sheet balance? Yes, it balances. If you've seen the earlier video where I showed you how to make a profit loss and balance sheet using a shortcut, you will observe this is exactly the same P&L and balance sheet that we prepared in that video. There we did it using a shortcut. Here we have done it using the accountant style. Let me know if this made sense. I hope you watched the other video and I hope you were able to relate with the two. Please continue sending your comments. Tell me what else would you like to know, and I'll be very happy to try and, wherever possible, make a video on those topics.